The market is currently closed. As of the closing bell on Wednesday, October 8, 2025, Cipher Mining Inc., ticker CIFR, settled at $17.60, marking a significant surge of $1.85 or 11.75% in a single trading session. Now, an 11% pop in a single day for a Bitcoin miner might have you thinking this is just another case of the stock riding the coattails of the digital assets' latest rally. That's the simple story, the one you'll hear in most places. The expectation is that when Bitcoin moves, Cipher moves with it, just with a bit more leverage. But the reality of what's happening under the surface at Cipher is far more nuanced and, frankly, far more interesting. This isn't just about the price of Bitcoin. It's a story about industrial-scale power strategy, operational excellence, and a calculated positioning that has begun to attract very serious attention from institutional players who typically stick to safer bets like Apple stock or blue-chip Fidelity ETFs. What we saw was not just a speculative surge, it was a repricing based on a growing recognition that Cipher might just have one of the most durable business models in the entire sector. Let's break down that double-digit gain. Most investors see a stock like Cipher Mining on their Robinhood app or SoFi Invest platform and categorize it as a high-risk, high-reward play on crypto. They see the price of Bitcoin go up and they buy, hoping to catch a wave. It's a perfectly understandable approach for self-investing, but it misses the critical details. The common belief is that all miners are created equal, their fortunes rising and falling in lockstep with the crypto market. But this assumption is fundamentally flawed. To look at Cipher's recent performance and attribute it solely to Bitcoin's momentum is to ignore the brutal efficiency that the company has been building. The real story here isn't about a digital asset, it's about megawatts, exahash, and long-term power contracts that other miners would do anything to secure. The trading volume accompanying that 11.75% spike was substantially higher than its daily average, which tells us this wasn't just retail enthusiasm. This was conviction buying, likely from larger funds using sophisticated platforms like interactive brokers trading systems or executing large blocks through Fidelity brokerage services. They aren't just betting on Bitcoin, they are making a calculated investment in Cipher's infrastructure. When we look closer at the recent market action, we see a pattern. Cipher has been consistently outperforming many of its peers, especially on days when the broader market shows weakness. While other miners might crumble when Bitcoin stagnates or pulls back slightly, Cipher has shown a resilience that points to a stronger underlying foundation. This is directly tied to their business model. Unlike some competitors who are exposed to the volatile spot market for electricity, Cipher has focused on securing long-term, fixed-rate power purchase agreements. They operate massive data centers in Texas, and their ability to lock in electricity costs gives them a predictable operational expense structure in an industry defined by unpredictability. This is the kind of detail that sophisticated investors using Fidelity wealth management services look for. It's not just about the potential upside, it's about downside protection. This strategic focus on power costs is Cipher's true moat, and the market is finally waking up to it. The recent price action is less of a speculative frenzy and more of a delayed reaction to the company's superior operational metrics, which have been evident in their quarterly reports for some time. It seems the institutional world, which has been pouring capital into names like Nvidia stock for its data center exposure, is now starting to see Bitcoin miners like Cipher as a unique and compelling part of that same infrastructure narrative. Cipher Mining is is, at its core, an industrial-scale Bitcoin mining company. It develops and operates large data centers specifically designed to house thousands of specialized computers known as ASICs, which work around the clock to solve complex mathematical problems. When they solve a problem, they are rewarded with new Bitcoin, which is how the Bitcoin network is secured and new coins are created. The company generates revenue by either selling the Bitcoin they mine or by holding it on their balance sheet, anticipating future price appreciation. Their primary costs are electricity and the capital expenditure for the mining hardware. This is where their strategy diverges from many others. By owning and operating their facilities, they maintain complete control over their operations. By focusing on long-term power contracts, often with wind and solar providers, they secure what is arguably the most critical input in their business at a predictable, low cost. This is a far cry from the early days of crypto mining. It's a sophisticated, capital-intensive industrial operation. Some investors may find this too complex for their online investing strategy and prefer a managed solution like Schwab Intelligent Portfolios, which diversifies across many asset classes. However, for those looking for direct exposure to this sector through an individual brokerage account, understanding this operational backbone is absolutely critical. Looking at their past performance, Cipher has been executing its growth plan with remarkable consistency. They've steadily increased their hash rate, the measure of their total computational power, by bringing new facilities online and upgrading their fleet of miners to the latest, most efficient models. This constant focus on efficiency, measured in joules per terahash, is vital, especially in the wake of the most recent Bitcoin halving event. The halving cut the block reward for miners in half, effectively doubling the cost of mining a single Bitcoin overnight for everyone. Miners with high electricity costs or inefficient hardware were immediately put under immense pressure, with some struggling to remain profitable. Cipher, however, had been preparing for this event for years. Their low fixed energy costs and highly efficient fleet meant that while their margins were compressed, like everyone else's, they were solidly profitable. This is the divergence that the market is now pricing in. The halving acted as a great filter, separating the efficient, industrial-scale operators from the less prepared. Investors are no longer just looking at a company's total hash rate, they're looking at its cost of production. On that metric, Cipher stands out as a leader. If you were looking for investment help on which miners would survive and thrive post-halving, you'd be looking for companies with exactly this profile. The future outlook for Cipher hinges on this interplay between the broader crypto market and its own operational execution. The expectation is that if Bitcoin continues its upward trend, Cipher's stock will produce outsized returns, and that's certainly a likely scenario. A higher Bitcoin price directly translates to higher revenue and wider profit margins for Cipher, allowing them to reinvest in more machines and expand their operations even faster. This would create a powerful flywheel effect, and investors on platforms like SoFi, who are comfortable with higher risk growth stories, are betting on this outcome. However, the more complex reality involves several other key variables. First is the price of energy. While Cipher is well protected by its long-term contracts, those contracts will eventually expire. Their ability to renew or find new agreements at similarly favorable rates will be a major test of their long-term viability. Any sign that their cost advantage is eroding would likely cause a significant reevaluation of the stock by the market. This is a risk that anyone considering opening a position through Interactive Brokers account services needs to monitor closely. Second, there is the ever-present regulatory landscape. The U.S. government's stance on crypto and Bitcoin mining remains a source of uncertainty. While some politicians have embraced the industry for its potential for job creation and energy grid stabilization, others remain concerned about its environmental impact. Any adverse legislation could pose a significant threat. Comment below what you believe is the biggest non-Bitcoin price-related risk facing the mining mining industry today? Regulation, energy costs, or something else entirely? Finally, there's the pace of technological advancement. The efficiency of mining hardware is constantly improving. This is both an opportunity and a threat. It's an opportunity because upgrading to newer machines can lower Cipher's cost of production. It's a threat because it requires constant capital investment, and falling behind the technological curve can be fatal. It's not a simple buy and hold like Tesla stock might have been for a decade. It requires active monitoring of industry trends. The company's ability to manage its balance sheet, access capital markets, and strategically upgrade its fleet will be just as important as the price of Bitcoin itself. Many looking for Fidelity mutual funds might find this level of company-specific risk too high, preferring a more diversified approach. In conclusion, the powerful 11.75% move in Cipher Mining stock is more than just a ripple from the broader crypto pond. The simple expectation is to see it as a leveraged bet on Bitcoin, but the reality is that this is a company being rewarded for its superior operational strategy in a fiercely competitive industry. Its foundation is built not on speculative hope,